Imagine looking at a 140-year-old industrial titan, right? Like the kind of massive soot-stained company that literally built the backbone of the 20th century. And then suddenly you realize it has this hyper-growth, futuristic tech darling, just, trapped inside of its balance sheet.
Yeah, it's essentially a classic corporate mullet.
Exactly. A corporate mullet. You've got the business in the front, which in this case is their legacy tire rubber division. And right now, that division is just bleeding out from an onslaught of cheap global imports. But then you walk down the hall and you have the party in the back.
The battery materials segment.
Right. A segment that is riding these massive tidal waves of electric vehicle adoption and the incredible energy demands of AI data centers. It's basically the old economy and the new economy fighting this brutal war for dominance right there on the exact same earnings report.
Which is exactly why Cabot Corporation, ticker symbol CBT, is one of the most fascinating transition plays we have analyzed in a really long time.
Welcome to Talk Tickers, by the way, where we put on our deep dive hats to give you, the retail investor, a fast, data-forward, and actionable breakdown of a single corporate earnings call.
And when you pull apart Cabot's Q1 2026 earnings call, you're not just looking at a standard quarterly update for a chemicals company, you're looking at a real-time stress test of global trade dynamics. It's a case study in how inflation alters consumer psychology and, honestly, a leading indicator for structural bottlenecks in the AI supply chain.
Yeah, the tension between their legacy operations and their future ambitions is just palpable on every single page of this transcript. So our mission today is to tear that transcript apart. As always, we promised you the headline numbers and the bottom line in under 5 minutes up front, and then we're going to spend the rest of this deep dive tearing into the absolute granular details of how a company actually manages an existential pivot while the engine is still running.
Right, you can't just stop the car to change the tires.
Speaking of tires, let's start with the headline figure that the algorithms and the headline scanners immediately reacted to. Cabot posted an adjusted EPS, so earnings per share, of $1.53 for the first quarter of 2026.
Which is a 13% drop compared to the same quarter last year.
Exactly. A 13% drop. Now, normally a double-digit drop in earnings per share is the kind of flashing red light that just sends retail investors running for the exits, right? But looking at that blended 1.53 is wildly deceptive.
It is entirely deceptive because it masks the extreme polarization happening inside the company's two main segments. When you blend a business that is contracting violently with a business that is growing exponentially, you end up with this mildly depressing average that tells you absolutely nothing about the underlying health of the enterprise. You have to bifurcate the analysis.
So let's bifurcate it. Let's start with the side of the business that is pulling that average down, the segment that's effectively contracting. Cabot calls this their reinforcement materials segment, or RM.
Right. And for anyone not steeped in industrial chemical nomenclature, this is their carbon black business. This is the foundational product the company was literally built on.
Right. It's the essential ingredient used to manufacture tire rubber. It provides the structural integrity, the durability, the heat resistance that actually allows a tire to survive highway speeds. And the numbers reported for this foundational segment are just incredibly grim.
Grim might actually be an understatement when you look at the raw operating leverage. Their EBIT, earnings before interest and taxes, for the reinforcement materials segment just plummeted by 22% year over year.
Wow.
Yeah, in raw dollars, that is a $28 million evaporation of operating profit in a single 3-month period.
That's a massive hit. So to understand why that profit collapsed so violently, we have to trace it back to the volume of product they're actually moving out the factory doors, right? Like how much physical soot are they shipping?
Exactly. And globally, their volumes fell by 7%. But the geographic breakdown is where the structural vulnerability of their entire business model is really exposed.
Right, because it wasn't an even drop.
No, not at all. In the Asia-Pacific region, volumes dropped a painful but, perhaps manageable 7%. But in the Americas, their volume plummeted by a staggering 15%.
A 15% drop in physical volume for a heavy manufacturing operation is a full-blown crisis. That means factory lines are sitting idle. It means overhead costs are just eating you alive because you aren't moving enough product to justify the massive fixed expenses of running these giant plants.
Right. The furnaces still have to burn.
Exactly. But I want to pause here and understand the mechanism behind that 15% drop, because a tire is a consumable good, right? People have to drive to work. Delivery trucks have to move Amazon packages, the rubber wears down, and eventually the tires just have to be replaced. So what is breaking the replacement cycle right now? Why are the Americas suddenly buying 15% less material for tires?
Well, management addressed this head-on during the call. CEO Sean Cohane pointed to a confluence of two distinct but compounding macro factors.
Okay, lay them out for us.
The first is just straightforward consumer economics. We have been in an inflationary environment for an extended period now. When the cost of groceries, rent, and basic utilities skyrockets, household budgets are stretched to the absolute breaking point.
Right. And a new set of 4 tires is what, like $600, $700, $800?
Easily. It's a significant high-ticket capital expenditure for a family. So what does the consumer do? They look at the tread on their current tires, they rationalize that it's, good enough for now, and they just delay the purchase.
The old penny test. If I can see Lincoln's head, I'm waiting another 6 months.
Exactly. They might push a replacement cycle from 36 months out to 42 or even 48 months. And furthermore, when they finally are forced by an inspection or a flat to buy new tires, they are actively trading down.
Meaning they aren't buying the premium brands.
Right. They bypass the premium, high-margin brands that Cabot historically supplies very heavily, and they opt for the absolute cheapest tier of tires available.
Okay, that makes intuitive sense from a behavioral economic standpoint. But delayed purchases eventually have to catch up. A delayed tire purchase isn't a lost sale forever. It's just a sale pushed into a future quarter. Because physics dictates you will eventually blow a tire if you drive on bald rubber long enough.
Right, eventually you have to buy.
But the second factor Cohane mentioned feels much more permanent and structurally damaging to Cabot. I am talking about the influx of cheap Asian tire imports flooding into Western markets.
And this is the real crux of the bear case against Cabot's legacy business right now. To grasp why this is so devastating, you really have to understand the fundamental logistics of carbon black as a material.
Okay, walk us through the physical reality of it.
So carbon black is incredibly difficult and expensive to ship over long distances relative to its value. It has extremely low bulk density. It's fluffy soot.
So it takes up a lot of space but weighs nothing.
Exactly. If you try to put it on a cargo ship across the Pacific Ocean, you're essentially paying exorbitant freight rates to ship a whole lot of air. Because of this physical constraint, Cabot operates on a strict make-in-region, sell-in-region manufacturing model.
Okay, so if I understand the strategy, they build a massive carbon black plant in Texas specifically to supply the tire manufacturing plants in the U.S., Midwest, and South. Or they build a plant in Europe to supply the European auto industry. They physically anchor themselves to their local customers.
Precisely. They create a localized, highly integrated supply chain. But that localized model has a fatal flaw when global trade dynamics shift.
Let me guess. Finished tires don't have that shipping constraint.
You hit the nail on the head. Let's say a Chinese tire manufacturer has massive excess capacity, subsidized capital, and access to extremely cheap shipping containers now that post-COVID freight rates have completely normalized. They can manufacture a finished tire in Asia using carbon black produced in Asia, pack those finished, dense, highly stackable tires into shipping containers, and flood the U.S. and European markets at a price point that domestic manufacturers simply cannot match.
Oh, wow. So the American consumer, who is already feeling the pinch of inflation, walks into a discount tire store and just buys the imported Asian tire because it's cheaper. And by doing so, they completely bypass the domestic tire manufacturer.
Yep.
And if the domestic tire manufacturer isn't making tires, they don't buy carbon black from Cabot's Texas plant. The demand simply vanishes across the ocean.
And the mathematical consequence of that vanished demand is brutal. Because of this localized model, when regional tire production drops, Cabot's regional factory utilization rates just fall through the floor. During the earnings call, management actually revealed that in the Americas, their industry utilization rates dipped below 80%.
Let's hover on that 80% metric for a second, because in the context of industrial chemistry and heavy manufacturing, utilization rate is the only number that dictates survival. I mean, these are massive capital-intensive facilities. They require constant maintenance, highly skilled labor, and massive energy inputs just to keep the lights on and the furnaces hot, regardless of whether they are producing 1 ton of product or 10,000 tons.
It all comes down to the ratio of fixed costs to variable costs. When your utilization rate is running at, say, 95%, you are spreading those massive fixed costs over a huge volume of product. Your profit margins are nice and wide.
You're printing money.
Right. But as utilization drops below 85% and then crosses that critical 80% threshold, your fixed costs remain exactly the same, but you have significantly less revenue coming in to cover them. The margin compression accelerates exponentially the lower the utilization goes.
So that's why a 15% drop in volume resulted in a disproportionate 22% plunge in EBIT. The operating leverage just viciously works against you on the way down.
Exactly. Which brings us to the absolute bloodbath of the 2026 contract negotiations.
Oh yeah, let's talk about the negotiations. Because in this sector, they aren't just selling carbon black on the spot market day by day, right? They negotiate massive annualized supply agreements that lock in pricing and volume for the entire year.
Right. They set the baseline for the next 12 months. And Cabot walked into the negotiating room for the 2026 contracts holding a very, very weak hand.
I can't imagine.
I mean, think about it. They had factories running below 80% capacity. Their domestic tire customers were bleeding market share to imports, and rival carbon black producers were equally desperate to secure whatever dwindling volume was left just to keep their own plants running.
It was a textbook buyer's market.
Completely. During negotiations, Cabot attempted this defensive strategy. They tried to hold the line on base pricing by emphasizing their value proposition. They argued that their reliability, their superior quality control, and the security of a localized supply chain were worth a premium over competitors.
But let me guess, in an environment where the end customer, the tire manufacturer, is fighting for their very survival against cheap imports, reliability takes a total backseat to raw cost.
Exactly. The competitive pressure from other domestic suppliers desperate to fill capacity was just overwhelming.
And the dam broke. CEO Sean Cohen had to admit on the call that they took a massive hit across the board, with global pricing declining by 7 to 9%.
Yeah, 7 to 9%.
That is just pure margin evaporating into thin air. But the situation in Europe was even more illustrative of the bind they're in, right? Because in Europe, management decided they were not going to chase the bottom. They actually tried to stand their ground on price, refusing to sign contracts that would lock them into unprofitable margins. And what was the result of playing hardball?
The result was that they actively lost sales volume. Competitors undercut them, took the contracts, and Cabot just had to walk away. They chose to protect their margin percentage at the expense of absolute volume.
Wow. But as we just discussed regarding fixed costs, walking away from volume means even less product flowing through their European plants in 2026, which threatens to push their utilization rates in that region dangerously close to unviable levels. It is a terrible game of chicken. Do you slash prices to keep the factory running, or do you hold prices and risk the factory sitting idle?
It's a phenomenal demonstration of how fragile a localized manufacturing strategy becomes in the face of unhindered global trade. The only thing that can really protect a make-in-region business model from a flood of cheap imports is government intervention.
And this was a major point of discussion during the Q&A portion of the earnings call, wasn't it? An analyst from Mizuho, John Roberts, directly pressed management on the import data and what, if anything, could stem the tide.
Yeah, and the response from the TEO provided a very clear look at how dependent this legacy business is on geopolitical policy. He pointed to Brazil as the prime example of what Cabot wants to see happen globally.
What did Brazil do?
Well, the Brazilian government recognized the damage being done to their domestic auto and tire supply chain by Chinese imports, and they implemented aggressive, targeted tariffs. And the data shows that the tariffs worked exactly as intended. Following the implementation, Brazil saw a 4% year-over-year decline in imported tires.
So the tariffs basically act as a dam. They stop the flood of cheap finished goods, which forces the regional demand back toward the domestic manufacturers, who then ramp up production and turn back to Cabot for their carbon black. It artificially restores that localized ecosystem.
From Cabot's perspective, yes. It protects the local tire manufacturers, ensuring Cabot's local plants maintain that critical 80+% utilization.
But the problem is that Brazil is an isolated success story right now, isn't it?
Unfortunately for Cabot, yes.
Yeah.
When you look at the U.S. market, while management noted that imports from Asia have declined slightly on a sequential month-by-month basis recently, they're still up approximately 4% year-over-year. The damage is still compounding. The situation in Europe is far worse. Imports are up 8%, and there are virtually no immediate protectionist measures currently in force.
Though they did mention a glimmer of hope on the regulatory horizon for Europe, right? There is an anti-dumping petition currently winding its way through the bureaucratic process. But any potential relief from that wouldn't materialize until June of 2026 at the earliest. That means Cabot has to survive another year and a half of this punishing margin compression in Europe without a safety net.
Which is exactly why the tone around the legacy business is so defensive. They're trapped in a holding pattern, just praying for tariffs and an easing of consumer inflation to unfreeze the replacement cycle.
Okay, so we have thoroughly explored the freezing living room of this corporate house. The legacy engine is sputtering, margins are getting compressed, and global trade is just eating their lunch. Now, I want to walk down the hall and open the door to the kitchen, which is absolutely engulfed in flames, but in the most lucrative way possible. We need to talk about the performance chemical segment, and specifically the hyper-growth phenomenon happening inside their battery materials product line.
Right. This is where the narrative shifts from defensive survival to aggressive, forward-looking expansion. If you look at the broad performance chemical segment as a whole, it performed decently. It saw EBIT increase by 7%, which translates to an additional $3 million in profit.
Which is nice, but not mind-blowing.
Exactly. The broad segment number obscures the true standout performer. When you isolate the battery materials product line, the growth metrics are astonishing. They reported revenue growth of 39% year over year for this specific group.
I just want to contextualize that number for everyone listening. A 39% year over year revenue growth rate inside a 140-year-old legacy industrial materials company is an absolute anomaly. That is the kind of aggressive scaling you expect to see in a Series C Silicon Valley software startup, not in a company that makes its money processing heavy chemical.
And it becomes even more impressive when you look at the profitability of that growth, because often when a division is growing at 39%, it is burning massive amounts of cash to acquire market share, right? It's unprofitable growth. But Cabot is boasting trailing 12-month EBITDA margins of 22% in the battery business.
Let's ensure the significance of that metric is crystal clear. EBITDA, earnings before interest, taxes, depreciation, and amortization, is Wall Street's preferred proxy for the pure operating cash flow a business generates. A 22% margin means that for every $100 of advanced battery materials Cabot sells, they are retaining $22 in raw operating cash before all the accounting maneuvers. In the physical manufacturing world, where margins are traditionally fought over in the single digits, a 22% margin is incredibly lucrative. It is a cash printing machine.
It really is. So the fundamental question becomes, what exactly is Cabot doing in the battery space that commands such an incredible premium? And what is driving this insatiable demand?
Right. Why are they printing money here?
The answer lies in two generational macroeconomic tailwinds: the global transition to electric vehicles and the explosive build-out of energy storage systems driven by the AI revolution.
Let's take the EV tailwind first. What exactly is Cabot selling to these automotive companies? Because they aren't building the batteries themselves, they aren't mining the lithium out of the ground. What is their specific niche in the battery supply chain?
Cabot manufactures what are known as highly engineered conductive additives.
Conductive additives. Okay, break that down for us.
To understand their value, you have to look at the basic chemistry of a lithium-ion battery. Inside a battery cell, you have active materials in the cathode and the anode that actually store the energy. But those active materials, on their own, are often very poor electrical conductors.
Interesting.
Yeah, if you just packed a cell with active materials, the energy would be trapped. You wouldn't be able to get the power out fast enough to accelerate a car, and you wouldn't be able to push power in fast enough to achieve rapid charging times.
So you need a conductive network to move the electrons around.
Precisely. Cabot's conductive carbons, products like their Litex brand, act as the electrical veins within the battery. They are mixed into the active materials to form a microscopic percolation network, a superhighway that allows electrons to travel rapidly throughout the cell.
So it's basically the plumbing for the electricity.
Exactly. And by engineering the morphology and the purity of these carbon particles at a microscopic level, Cabot allows battery manufacturers to increase energy density, improve rapid charging capabilities, and extend the overall lifespan of the battery pack.
And because these additives are so heavily engineered and critical to the performance of a multi-$1,000 battery pack, Cabot can charge that 22% premium. It's a low-volume, incredibly high-value ingredient. But having a great product is only half the battle, right? You still have to secure the market. And this is where Cabot is applying the lessons they learned from their legacy tire business regarding localized supply chains. They just announced a massive multi-year supply agreement with a company called Powerco.
Which is a monumental strategic victory. Powerco is not just a secondary player. It is a wholly owned subsidiary of the Volkswagen Group.
Wow. Okay.
Yeah, Volkswagen is the second largest automotive producer on the planet, and they are executing a massive strategic pivot to secure their own destiny in the EV race. Rather than relying entirely on Asian battery giants like CATL or Panasonic, Volkswagen is investing billions to build out their own massive gigafactories across Western Europe and North America to vertically integrate their battery supply chain.
And Cabot wants to be the local supplier right next door to those gigafactories.
More than just being next door, they want to establish what management repeatedly referred to on the call as incumbency.
Incumbency, I like that word. Explain why that matters in auto manufacturing.
It is a crucial concept in heavy automotive manufacturing. When a company like Volkswagen designs a new battery architecture for a gigafactory, they have to qualify every single material that goes into that cell. They run months, sometimes years, of rigorous testing to ensure safety, performance, and chemical compatibility.
Right.
Once Cabot's specific conductive additives are designed into that base architecture, once they achieve incumbency, it becomes incredibly risky and expensive for Volkswagen to ever switch suppliers.
Oh, because if they switch out the conductive additive later to save a few pennies, they might accidentally alter the thermal dynamics of the cell and cause a catastrophic failure in the field.
Exactly. You don't mess with their recipe once it works.
So the switching costs are astronomically high. By getting in on the ground floor with Powerco's Western gigafactories, Cabot is essentially building an impenetrable moat around future revenue.
That is the exact strategy. During the Q&A, Kevin Estock, an analyst from Jefferies, tried to get management to put a specific dollar figure on what the Powerco deal would mean for earnings over the next few years.
Did they give him one?
No. CEO Sean Cohane declined to give a specific numerical forecast, but his qualitative answer was really telling. He emphasized that this agreement is merely the first step in a multi-site, multi-year expansion strategy. He categorized it as a material contributor to their long-term profit growth, solidifying their footprint in the West, just as the EV supply chain is actively trying to onshore away from China.
So the EV story is a massive driver of that 39% growth. But as we comb through the transcript, there is a second tailwind that feels even more explosive to me. It's the sleeper catalyst that I don't think the broader market has fully priced into Cabot's valuation yet. I am talking about the direct connection to the artificial intelligence boom.
Right. This is where the story pivots from an automotive transition to a fundamental technology infrastructure play. Everyone understands that the AI revolution requires massive data centers packed with highly advanced GPUs running complex training models.
Right, NVIDIA chips everywhere.
Exactly. But the physical constraint that is rapidly emerging for these AI data centers isn't just silicon. It is raw, uninterrupted electricity.
Let's expand on that constraint because it's fascinating. When you are running a massive AI training model that takes weeks or months to complete, the servers are drawing an immense, constant thermal and electrical load. And the worst thing that can possibly happen is a momentary fluctuation or brownout on the local power grid. If the power drops even for a fraction of a second, an entire training run could be corrupted, resulting in millions of dollars in wasted compute time. You simply cannot run an AI data center on a grid that is susceptible to instability.
To solve that instability, data center operators are moving away from traditional slow-to-react diesel backup generators and are instead installing massive energy storage systems, or ESS.
Paint a picture of what an ESS actually looks like.
These are essentially gargantuan battery farms, often the size of shipping containers, parked right next to the data centers. They act as a massive buffer, absorbing power when the grid is stable and instantly deploying it the microsecond there is a fluctuation, ensuring the GPUs never experience a drop in voltage.
And the projected growth for this ESS market is staggering. Management cited projections that ESS demand will grow at a 26% compound annual growth rate through 2030.
26% CAGR.
That is sustained hypergrowth over a multi-year horizon. But how does Cabot fit into a shipping container-sized battery? Do these massive storage systems need the same highly engineered conductive additives that a high-performance EV battery needs?
That was the exact tension raised by an analyst from UBS, Josh Spector. He asked a phenomenal, highly technical question during the call.
What did he ask?
He pointed out the fundamental difference in form factor. An electric vehicle battery is highly space constrained. You have to cram as much energy density as possible into the floorboard of a car, which justifies paying a premium for advanced additives. But an ESS battery farm sitting in an empty field next to a data center isn't constrained by space. If you need more power, you can just build a bigger box.
Right.
Specker's question was, if space isn't an issue, do data center operators really need Cabot's expensive premium conductive carbons, or will they just use cheaper generic alternatives?
That is a brilliant pushback. If the constraint is just overall capacity, why pay for the Ferrari of carbon black when a Honda Civic version will do the job?
CEO Sean Cohane's answer demonstrated the absolute depth of Cabot's technical moat. He acknowledged the spatial difference, but he countered by explaining the operational demands of an ESS environment. While EVs prioritize rapid charging in space, ESS batteries prioritize thermal stability and, most importantly, extreme cycle life.
Cycle life, meaning how many times it can charge and discharge.
Exactly. These data center batteries are constantly cycling, absorbing, and discharging power to balance the grid load. If you use cheap, generic conductive additives, the internal resistance of the battery is higher, which generates excess heat and rapidly degrades the active materials. The battery dies faster.
And replacing a shipping container full of degraded lithium-ion batteries every 3 years destroys the unit economics of the data center.
Exactly the point Cohane made. He explained that Cabot's advanced Enermax and Litex brands are engineered to create a highly efficient conductive matrix that drastically reduces internal resistance, thereby extending the cycle life of the battery pack significantly.
So the data center operators gladly pay the premium for Cabot's additives because it pushes the replacement cycle of their multi-million-dollar ESS installations out by years.
Yes. And crucially, Cohane confirmed that the profitability for Cabot in supplying the ESS market is just as lucrative as their EV contracts.
Wow. So we have thoroughly mapped the two disparate halves of this company. We have the legacy tire business freezing in the Americas, taking 22% EBIT hits and fighting for scraps in a flooded market. And we have the battery business on fire, growing at 39% with 22% EBITDA margins, locked into VW gigafactories and AI data center build-outs. But I have to play the skeptic here.
Go for it.
When you look at the total revenue pie, the tire business is still the behemoth. The battery growth is incredible. But in absolute dollar terms, isn't this hypergrowth in batteries just putting a tiny Band-Aid on a massive bleeding arterial wound right now? If global tire pricing is dropping 9%, how can a 39% growth in a smaller division save the quarter?
You have identified the central overarching tension of Cabot as an investment thesis right now. The battery business is unequivocally the future of the company, but it lacks the current sheer scale to completely offset the massive cash flow destruction happening in the legacy tire business.
So they are racing against the clock.
Very much so. The legacy tire business, despite its struggles, is the cash-generating engine that is funding the capital-intensive pivot into batteries. If that legacy engine seizes up entirely before the battery business achieves dominant scale, the entire transition plan collapses.
Which means we need to rigorously examine how management plans to navigate this treacherous middle ground. The future is bright, but the present is dangerous. How are they planning to stop the bleeding in the legacy business while they wait for the battery revenues to compound? That brings us to their management guidance and their specific operational countermeasures. Let's look into the crystal ball they provided for Q2.
Well, if investors were hoping that Q1 was the bottom, the guidance for Q2 is a sobering reality check. Management was brutally transparent on the call. It is going to get worse.
How much worse?
They're projecting another $5 million to $10 million sequential drop in EBIT for the reinforcement materials segment in Q2.
I just want to clarify that word sequential for our listeners. They don't mean a drop compared to last year. They mean it is going to drop another $5 to $10 million from the already depressed Q1 number we just analyzed. The bleeding is accelerating. Why?
Because of the lag effect in those brutal 2026 contract negotiations we discussed earlier. In Q1, they were still shipping some product under older, slightly better pricing structures.
I see.
But in Q2, those new lower prices, that 7 to 9% global price cut they were forced to swallow just to maintain volume, that officially hits the income statement in full force. The theoretical pain of the negotiating table becomes actual pain on the balance sheet.
So the top line revenue is mathematically guaranteed to shrink in the legacy business in Q2. Yet despite forecasting the sequential drop, management confidently narrowed their full year 2026 EPS guidance to a range of $6 to $6.50. How is that mechanically possible? If your core product is selling for 9% less and your volumes are structurally depressed by cheap imports, how do you maintain your full-year profitability targets?
You do it by viciously attacking your cost structure and fundamentally altering your physical manufacturing footprint. Management is pulling every conceivable defensive and offensive lever they have right now. On the defensive side, they are wielding a machete.
Tell us about the cuts.
They already executed a program that delivered $50 million in structural cost savings during fiscal 2025. Now, facing this new pricing reality, they've announced an additional target of $30 million in hard cost cuts for fiscal 2026.
Squeezing $80 million out of an operating budget over 2 years is not just trimming the fat, that is cutting deep into the operational muscle. Where exactly is that $30 million coming from this year?
It comes from the classic playbook of an industrial company under siege. First, procurement savings, which translates to aggressively renegotiating contracts with their own suppliers for raw materials and energy inputs. Second, they're accelerating the deployment of advanced manufacturing technology to marginally improve the yield of carbon black they get from every single barrel of feedstock.
Just squeezing every drop of efficiency.
Exactly. And third, inevitably, it means headcount reductions within the reinforcement materials segment. But the cost cutting goes beyond operational expenses. They are taking drastic action on their capital allocation. Management announced they are slashing capital expenditures, CapEx, by $60 million at the midpoint compared to their 2025 spending levels.
Let's dissect the implications of slashing CapEx by $60 million. Capital expenditure in a heavy chemical company is the money spent on upgrading facilities, replacing aging equipment, performing heavy maintenance, and building new lines. When you cut CapEx that drastically, you are essentially deciding to run your existing equipment harder and longer without upgrading it. It preserves cash in the short term, which they desperately need, but it increases the risk of operational outages in the long term.
It's a calculated risk.
There.
But the most aggressive defensive move they announced wasn't just delaying maintenance, it was their plan to actively shrink the company.
Right. This is the most critical strategic shift discussed on the call. Management formally announced that they are finalizing plans to, in their words, rationalize carbon black capacity in both the Americas and Europe.
And we need to strip away the Wall Street euphemisms here. Rationalizing capacity is polite corporate jargon for shutting down entire factories, laying off the workforce, and permanently removing production lines from the grid.
That is exactly what it means. It is a painful but mathematically necessary maneuver. Remember our discussion about the 80% utilization threshold?
Yep, where fixed costs start eating you alive.
Right. When a region is flooded with imports and your local utilization drops below 80%, every single plant in that region is operating inefficiently and bleeding margin. By making the hard choice to permanently close your oldest, least efficient, or least profitable plant in a region, you fundamentally alter the math. You take the production volume that was keeping that doomed plant barely alive, and you route it to your remaining facilities.
So by shrinking the total pie of available capacity, you force the remaining slice to work harder. The overall supply in the market tightens artificially. Suddenly, your 3 remaining plants, which were struggling at 75% utilization, are now running at a highly profitable 90% utilization because they absorb the volume from the closed plant.
Exactly. It restores your pricing power and dramatically improves the profit margins on every ton you sell. It is the ultimate defensive consolidation. But I want to play devil's advocate here, similar to a question raised on the call. If you are systematically closing plants in the Americas and Europe, aren't you effectively waving the white flag? Aren't you just permanently surrendering market share to the Chinese and Asian tire importers?
That's the obvious concern, yeah.
And here is where the strategy seems to contradict itself. In the exact same breath that management threatened to close plants in the Americas, they proudly announced they had just finalized an acquisition to buy a brand new carbon black plant in Mexico. How does it make sense to shrink and grow in the exact same hemisphere simultaneously?
That is the apparent paradox of their strategy. It looks like chaotic capital allocation, right? Closing a plant in Ohio while buying one in Mexico. But when you dig into the mechanics of the Mexican acquisition, a very calculated offensive logic emerges. David Begleiter, an analyst from Deutsche Bank, pressed management on this exact contradiction. He asked how adding a new plant in Mexico fits into a broader mandate to reduce global footprint.
And what was Cohane's explanation?
Well, CEO Sean Cohane's explanation highlighted a massive shift in global supply chains. The plant they acquired in Mexico is not just generic speculative capacity, it is a highly strategic asset. First, from an operational standpoint. The newly acquired plant is geographically adjacent to an existing Cabot facility in Altamira, Mexico.
Okay, so there are immediate synergies.
Massive synergies. They can consolidate site management, share logistics networks, and optimize feedstock purchasing across both facilities.
Synergies are a great way to save a few million on overhead, sure, but they don't justify buying a plant if the overall demand for tires is falling. Why deploy precious capital in Mexico right now?
Because the demand curve in Mexico is fundamentally different than the U.S. right now, driven by the massive macroeconomic trend of nearshoring. Automotive manufacturers are aggressively moving their supply chains out of Asia and into Mexico to comply with the USMCA rules of origin and to insulate themselves from trans-Pacific shipping risks.
And where the auto plants go, the tire manufacturers follow.
Exactly. But the most critical detail of this acquisition is how it is structured financially. Cabot didn't just buy a plant hoping to find customers. The entire acquisition is underpinned by a massive long-term supply agreement with Bridgestone.
So this is a contracted revenue play. It is effectively a take-or-pay scenario.
Precisely. They are buying guaranteed volume and guaranteed revenue. Cabot is strategically trading generic, highly vulnerable, uncontracted capacity in the US or Europe, capacity that is getting destroyed by cheap spot market imports, and replacing it with highly contracted, guaranteed margin capacity in Mexico, tied directly to a Tier 1 partner like Bridgestone.
So they are cutting the unprofitable fat to invest in guaranteed muscle.
Exactly. Additionally, they noted they are ramping up new, lower-cost capacity in Indonesia to better serve the localized Asian markets directly, further shifting their center of gravity away from the vulnerable Western legacy plants.
So they are playing a very aggressive game of geopolitical chess. They are actively retreating from the theaters of war where they have no structural advantage, like the untariffed US and European spot markets, and they are advancing rapidly in regions where they have deep strategic partnerships, nearshoring tailwinds, or inherent cost advantages. And by slashing that $60 million from their CapEx budget, they ensure they have the liquidity to execute this reshuffling without bankrupting the company.
Which brings us to the financial foundation of the entire enterprise. CFO Erica McLaughlin spent a significant portion of her prepared remarks emphasizing the company's cash flow resilience. Despite the 22% plunge in their primary segment's EBIT, she highlighted that Cabot still generated $71 million in discretionary free cash flow during the quarter.
Discretionary free cash flow is the lifeblood of a company in transition. That is the actual cash left in the checking account after every operational expense, tax bill, and necessary capital expenditure has been paid. That $71 million is what gives management the autonomy to make choices. It funds the dividend, it funds the acquisitions, and it funds share buybacks.
Which leads us perfectly into the final critical synthesis of our deep dive. Taking all of these complex moving variables, the collapsing tire margins, the exponential battery demand, the aggressive plant closures, and the strategic geographic reshuffling, what's the definitive actionable takeaway for the retail investor listening right now? Is this a falling knife or is it a misunderstood opportunity?
To make that determination, we have to look beyond the income statement and scrutinize the balance sheet. A corporate transition of this magnitude, shifting from a legacy industrial supplier to a high-tech battery materials provider, is inherently dangerous. If a company attempts a pivot like this while carrying a massive debt load, any slight miscalculation or prolonged downturn in the legacy business will trigger a liquidity crisis. The banks will call the loans and the equity gets wiped out. So how much risk is actually built into Cabot's capital structure?
The answer is surprisingly little. Cabot's balance sheet is an absolute fortress. They reported $1.4 billion in total available liquidity. But the metric that truly defines their safety margin is their net debt to EBITDA ratio, which currently sits at a highly conservative 1.2x.
For our listeners who aren't parsing debt covenants every day, let's contextualize why a 1.2x ratio is the definition of a financial fortress. Net debt to EBITDA essentially measures how many years it would take a company to completely pay off all its outstanding debt if it devoted every single dollar of its operational cash flow to debt service. In the heavy chemicals and industrial manufacturing sector, where massive factories are routinely financed with debt, it is incredibly common to see companies operating with ratios of 3x, 4x, or even 5x.
Oh yeah, 3x is standard.
At a ratio of 1.2x, Cabot operates with virtually zero existential risk. Even as the legacy tire business remains structurally depressed by Asian imports for another 3 to 4 years, the banks are not going to come knocking. Cabot has an immense runway to execute their transition.
And that immense runway allows them to implement a capital return policy that aggressively rewards patience. This is the most compelling argument for the stock. Even during this brutal quarter, where their core engine misfired badly, management utilized that $71 million in free cash flow to actively reward shareholders. They paid out $24 million in safe, reliable dividends. And more tellingly, they executed $52 million in share buybacks.
Share buybacks during a cyclical downturn are the ultimate signal of executive confidence. When management uses precious cash to buy and retire their own stock while the market is punishing the share price due to legacy headwinds, they are screaming to the market that they believe the underlying asset is vastly undervalued. They are mathematically increasing the ownership stake of every remaining investor without those investors having to spend a dime.
So, synthesizing all the data, what is our opinionated verdict on Cabot Corporation?
This is a textbook hold and accumulate scenario. It is a classic, albeit turbulent, transition play. You have to be clear-eyed about the immediate reality. The results in the legacy tire business are objectively weak. And because of those new, lower-priced 2026 contracts, the Q2 numbers are going to look even uglier on paper. The financial headlines next quarter might induce panic in retail investors who only read the top-line EPS drop.
But the underlying mechanics suggest that the legacy pain is cyclical, while the battery growth is structural. The macroeconomic headwinds suppressing the tire replacement cycle, specifically inflation and high interest rates, will eventually ease. The consumer can only delay replacing bald tires for so long. Eventually, physics dictates they must buy, and when that delayed replacement cycle finally unfreezes, a massive wave of volume will rush back into the localized supply chains, rapidly improving Cabot's utilization rates and margins.
Here is the actionable strategy for you, the listener. If you currently hold Cabot stock, do not panic when the Q2 guidance hits and the numbers look soft. You are being paid a secure dividend to wait. You are watching a highly competent management team utilize a fortress balance sheet to surgically extract cash from a low-margin legacy rubber business and reinvest it into a hyper-growth 22% margin battery materials business.
And if you don't own it yet?
If you are a potential buyer looking for an entry point, patience and volatility are your allies. Wait for the Q2 earnings release. When those new depressed tire contracts officially hit the income statement, the market algorithms might overreact and punish the stock, creating a beautiful discounted entry point. You want to accumulate shares now while the market is still pricing Cabot as a struggling tire company before the massive EV and AI data center revenues become the dominant narrative driving the valuation, which the data suggests will occur late in 2026 or into 2027.
It is essentially a bet on the management team's ability to manage the decline of the old while incubating the new. And their transparency on this call, their willingness to openly discuss the brutal reality of the 2026 contract negotiations and the painful necessity of plant closures, it suggests a management team that is not hiding behind accounting tricks. They are facing the structural reality of the global market and aggressively re-engineering the physical footprint of the company to survive it.
It is like watching a seasoned captain completely rebuild the engine of a massive cargo ship while actively sailing through a hurricane. It is going to be a violent, bumpy ride for the next few quarters. They are going to have to throw some heavy cargo overboard, shutting down older, inefficient plants in the Americas and Europe just to keep the ship upright. But the destination they are navigating toward, this promised land of dominating the conductive additive supply chain for the global AI and EV transition, is immensely lucrative. The hull is strong enough to survive the storm, as evidenced by that 1.2x debt ratio.
The transition is messy. The geopolitics are complex. But the underlying financial mechanics remain fundamentally sound.
We have certainly gone deep into the weeds today, but when the narrative is this bifurcated, you cannot rely on surface-level analysis. You have to follow the margins down to the molecular level. Let's summarize the journey we took. We started with a deceptive 13% drop in blended earnings per share and tore it apart. We diagnosed a legacy tire business struggling against inflation and a flood of cheap Asian imports, forcing brutal contract concessions and painful factory closures.
But beneath that carnage, we uncovered an explosive 39% growth engine hidden inside a legacy chemicals company, a highly profitable battery materials division locking in massive contracts with Volkswagen gigafactories and providing critical energy infrastructure for the AI data center boom.
We charted management's aggressive cost-cutting measures, their strategic repositioning in Mexico, and mapped out a clear, actionable thesis for investors navigating this transition.
It is a phenomenal case study in corporate evolution.
Before we sign off, I want to leave you with a final forward-looking thought experiment based on the trajectory we mapped today. We established that the energy storage sector, fueled by the insatiable power demands of AI data centers, is projected to compound at an incredible 26% annual rate through the end of the decade. Right now, Cabot's strategy is to use the cash generated by the legacy tire business to fund the capital required to build out this battery empire, but project this out to 2028 or 2030. As those high-margin AI and EV battery revenues scale exponentially and become the dominant driver of profitability, the legacy tire business will increasingly become a drag on the overall multiple. Could we see a future where management decides the transition is complete and they spin off or sell the legacy tire rubber division entirely? Could we witness this 140-year-old soot and chemicals manufacturer completely shed its industrial skin and emerge as a pure-play, high-multiple technology and energy storage darling? Keep a close eye on the balance of power between those two segments over the next few years. The ultimate value play might be hiding in plain sight. Thanks for diving deep into the numbers with us today. Keep interrogating the data, and we will catch you next time.